This is Alan Bush with the Daily Financial Forecast for Thursday, October 6th. First of all, I'd like to begin with this comment. Prospects of tighter credit from the Fed, especially at the December meeting, are dominating all of the financial markets, including stock index futures, which are under a little pressure today. So this influence being offset by the bullish factors, including crude oil prices that have advanced to a 4-month high. Also, we had the jobless claims report at its lowest level since almost 1973. However, we do feel that longer term stock index futures will continue the bull market. We also feel that even though there's so much, I would almost call it hysteria, that the Fed will be raising at the December meeting, our feeling is that there is probably less of a chance than most analysts are thinking of a December rate increase. Either way, if the Fed does raise in December, or if they wait till next year, the next rate increase will not tip over this bull market. Rates are not simply high enough with another rate increase that will halt this bull market in the indices. So with or without a rate increase, the bull market will continue for stock index futures. Now, moving over to the currencies, the dollar index is very strong again, and of course for the same reason, more talk of a rate increase from the Fed later this year. By the same token, this is putting pressure on almost all of the other major currencies, including the British pound, which is under some pressure in addition to interest rate differentials. More talk that the EU is becoming more resistant to the UK exit as far as trade negotiations. Of course, the UK did vote on June 23rd to leave the European Union. Also, some pressure in the euro currency, even though we did have German factory orders coming in much better than expected, up 1%. And we are seeing the Japanese yen lower as interest rate differentials continue to pressure the yen now for a 7th consecutive day. Even the commodity currencies, the Canadian dollar and the Australian dollar, which would normally be higher on advancing crude oil prices, are both lower. Once again, this is due to more talk of a Fed rate increase this year. Longer term, though, we feel that the dollar index will probably continue to work higher, even though it is overreacting, I think, on the upside. Still thinking the main trend is higher for the greenback, especially since the Fed is the only major central bank somewhere down the line that will be raising interest rates. As far as the precious metals, gold and silver, I think very much overreacting to all of this talk of a Fed rate increase. Some support areas taken out, a lot of panic selling, but I do not believe that we are in the early stages of any type of bear market. In fact, I do not think we are going to be in a bear market. I think this is just a washout. Over the next few days, I would expect the precious metals to stabilize and then gradually work higher again. Longer term, gold and silver still appear to be headed much higher. In the interest rate futures markets, talk of more increases in the rates from the Fed, actually working in our favor with our bearish ideas on the 30-year bonds, and I would not be surprised to see the mid-September lows in the 30-year bonds to be taken out within the next 3 or 4 weeks, possibly sooner. Also, inflation that we see coming back, that others apparently do not, will remain a long-term negative on the bonds. So look for lower prices in the interest rate futures markets, especially for the 30-year Treasury bond futures. So good trading, everyone. Once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.